on monetary policy in the US in context of the May 6th FOMC meeting, Mary Daly, president of San Francisco Fed, indicates three factors within her reasoning. The first factor is her acceptance of the outlook for a few interest rate cuts for fiscal 2025. At the same time, she indicates that there is less need for intervention by Federal Reserve due to rising risks of inflation. Lastly, she indicates that uncertainty because of White House trade tariffs has done little to disrupt solid US economic growth. President Daly indicates that monetary policy outlook for fiscal 25 is actually for looser policy, which is indicated by her factoring in multiple benchmark rates adjustments. At the same time, she is hawkish by indicating that there is less need for intervention by the Federal Reserve because of inflation risk. That means she includes the risk that inflation flares up and monetary policy needs to be restricted to incorporate the risk. As Jan Hatzius of Goldman Sachs indicated that incorporating tariffs into the fiscal 25 outlook at the initial salvo of tariffs would still undershoot the target inflation rate by the Fed. The second and the third salvo of Trump tariffs raised the outlook for inflation risk substantially. Jan argues we have now an inflation risk to the upside that is already materially affecting the yield curve outlook over the next 6 months to be specific. The ECB is indicative they are well aware of the risk the proliferated yield curves in the Eurozone are going to materially affect by additional volatility in the American benchmark yield curve, as defined by Jan Hatzius of Goldman Sachs. Goldman Sachs wants to point out a key issue. The average rated sovereign's yield curve is diverging from the US benchmark yield curve. This can be a source of future volatility, debilitating debilitating volatility. We will look to deepen our insights on the issue over the short term. The ECB indicates they have been aware of material market developments by that specific dynamic in the US 10 year and have made effective measures to quell volatility in the sovereign 10-year yield curve and are standing by to implement more intervention to ensure sovereign debt stability as a source of financing financing subjected to market volatility. The final point is of great interest. The fact that Trump trade tariffs have caused so much uncertainty and volatility trickling through the global economy has somehow left US economic activity unscathed. It is very interesting. So an indirect implication is if the US economy compensated for losses affected by Trump trade tariffs policy within other economic scenarios, or has the real US economy never been materially affected by the uncertainty over the Trump trade tariffs? A highly hypothetical approach, but at the same time worthy of study, according to Harvard University. On pending monetary policy response in China, markets have an outside focus on Chinese policymakers in terms of monetary policy. Policymakers who wish to support the Chinese economy. A key factor is the uncertainty caused by the intensifying trade war with the US. China monetary policy response today was to keep lending rates steady, reducing the immediate urgency for monetary easing, while expectations are our monetary stimulus will be delivered within the next few months. The key indicator is that growth is uncertain, especially during Trump global trade war. According to Goldman Sachs, the PBOC, People's Bank of China, guaranteed intervention before trade war tariffs came into existence, mainly assumed because the Chinese economic pillar model came under pressure. Given the benign uncertainty affecting the economic activity in China, the assumption implies that trade tariffs fortify that outlook in monetary policy intervention. If the monetary policy intervention offsets the malignant effects of the ongoing trade war, Jamie Dimon states that the effects of the trade war felt across the board are even not even past their initial phase of rippling through the global economy. We are effectively also still in a phase that political back and forth is still defining the global economic turmoil. JP Morgan states that the effects of only the first round of tariffs will be quantifiably known only within 9 months from today. In addition, there has been a second and third round of additional tariffs.